everybody, it's Brett here from Metropole, and the more you know about the type of mistakes that investors make, the better investor you're going to be. So again, in this series, we're talking about the common mistakes that investors make, and I'm joined today by Michael Yardney. How you going, Michael?
Hello, Brett. Thanks. I'm having a lot of fun doing this series with you.
Absolutely. Look, one of the bigger things that I get are people always trying to time the market, trying to get in at the right time or out at the right time. Why is that a common mistake, Michael?
Well, I guess that's sort of built into the way a lot of people want to trade: buy low, sell high, maximize the gain. But in reality, you can't pick the market. We've been in it long enough, and I've recognized that even the best experts, the banks, the Reserve Bank, all the economists can't pick the market. Now, again, the concept we have learned over the years is to buy counter-cyclically. Be fearful when others are greedy and be greedy when others are fearful. And sometimes you get it right. In fact, I did get it right in my first purchase way back in the 1970s, where I spent $18,000. I went halves with my parents. I put $2,000 deposit down, so did they, and we took a $16,000. Actually, I think I only put $1,000 down. That's all I had, and we took a $16,000 loan for 30 years. But the Labor government came into power at the time. The market went up quickly, inflation went up, and I thought, hey, I'm really smart. And in fact, I wasn't. I just happened to be at the right place at the right time. But that's what happens, and you can't replicate that. That's pure luck. So rather than trying to pick the market or pick the timing, what I believe investors should be doing is getting the right finance and buying the right property that they'd be happy to hold in the long term. The trouble is, Brett, a lot of people don't want to buy something and suddenly see it go down in value a little bit. And that's understandable. An element of that is ego, that, hey, look, I'm not so smart when it's happening. But interestingly, we've got on Property Update a number of articles from Stuart Waymes, who's a great financial planner, and also from Kate Forbes, our business partner, showing the charts and doing the digging in the homework and recognizing that if you buy $10,000, $20,000, $30,000 cheaper today, it's a one-off profit. What's more important, though, is if you can buy a property that goes up by, let's say, 8%, when the average for that state could be 6, 7% per annum over a long term, that big difference in capital growth by choosing the right property, the best asset, is what's going to make a big difference. And it's a compounding effect, and you don't pay tax on that. So rather than trying to pick the market, I would be suggesting you look for good opportunities. But the other thing I'd say is that I've noticed that some investors do well in good times, and they also seem to do well in bad times, and others do poorly in good times and also do poorly in bad times, or even worse. So some investors can do well whatever the marketplace is, and that's because they've got the right strategy, they've got the right mindset, they've got the right systems, and so therefore don't worry too much about what the market's doing. Think about what the market in between your ears is doing.
So what you're saying is, Michael, that it's that longer term focus, and the mistake that people are making is really having the blinkers and having the shorter term focus instead.
Sure. And let's give an example of the state where you're sitting in Brisbane. It hasn't performed as strongly as Melbourne and Sydney during the good times that we had a couple of years ago. But our clients who bought there were not buying the Brisbane property market. They bought individual properties within the market. And we have seen, when we reviewed them on our annual reviews that we do with our clients, that their properties have outperformed considerably because of the location they've bought in and the demographics. So don't be fooled with what's happening in the market. Buy the best asset you can.
So if we're talking about buying the right asset, are we talking about affordable properties or buying a bargain?
Well, that's again thinking a bit like timing the market. I'll get something that's a bit cheaper. And that's what a lot of those emails you get in your inbox sort of tease you to do. Go for distressed sales or mortgagee sales. No, what I've found over the time is that your money's going to run out before the opportunities will. So you should only be buying an investment grade property rather than investment stock. And we've spoken about that before. And Stuart Waymes, in one of my podcast recently, put it really well. He said you shouldn't just be buying a diamond, you should be buying a pink diamond, something really special and unique that's got some twist to it, some upside potential, below intrinsic value, the sort of property that's going to be in strong demand in the long term. Because if you buy that type of investment grade property, that will never be cheap, because currently we believe there's probably only about 4% of properties on the market that would be investment grade, and there are more people looking for those, and there always are, than there are those properties around. So therefore they're going to be more stable, they're not going to drop in value when the market turns down as much. But so it's not affordable properties, it's buying that pink diamond out of all those on the market.
Don't tell my wife about those pink diamonds, please, Michael. I'm sure she'll definitely understand what you're talking about. But look, one thing I believe is obviously picking the market. It's very that short-term focus and short-term approach. And one common theme we're going to continually talk about here is focusing on the longer term and buying with that in mind, rather than focus on the immediate future. So thank you for joining us today. I understand that this is a common mistake that many people make, and I encourage people to really think longer term rather than looking at the immediate future. Pick out that pink diamond.